So, what if you could spot the exact moment a powerful market trend was about to run out of steam? Well, in this explainer, we're going to unlock a tiny but really powerful clue hidden right there in your charts that can signal just that. Yeah, we're talking about just one single candlestick that captures this moment of pure indecision. A pause in the market story that often warns you that a major plot twist might be just around the corner. All right, first things first, let's set the scene. A doji is all about context. It doesn't just show up randomly. It appears at a very specific and, honestly, a crucial moment in the market's journey. I want you to imagine a stock that's just been on a tear, right? Climbing higher and higher, everything seems so certain. But then, boom, a doji appears. And suddenly, all that conviction behind the strong move starts to waver. It's like the market is taking a collective breath and asking, okay, what's next? The source material really nails it here. A doji reflects equilibrium. It's this moment of perfect balance between the buyers and the sellers. So this isn't just a pause. It's the market literally holding its breath, hinting that the big trend might be running out of gas. So what is really going on inside this little moment of indecision? Let's break down exactly what a doji looks like and the market psychology it reveals. It's a really simple shape that tells a surprisingly powerful story. Okay, here is the absolute key. During that trading session, the price might have swung wildly up and down, right? That's what creates those long wicks. But by the end of it all, it closes right back where it started. It's kind of like the market went on this long, crazy journey, only to end up exactly where it began. And this illustrates the dynamic perfectly. Seriously, think of it as a literal tug of war. You've got the bulls pulling with all their might to push the price up, and you've got the bears pulling just as hard to drag it back down. And the result? A total stalemate. Neither side wins, and that indecision gets printed right there on the chart for all of us to see. Now, this is where the real strategy comes into play. You see, a doji is just a clue. It's not a command. It's the market asking a question. So in this section, we're going to learn how to actually listen for the answer. If you remember just one thing from this whole explainer, please make it this. A doji on its own simply means uncertainty. It does not predict direction. Acting on it alone is basically a guess. The real skill is waiting for the market to show you its hand. So here's a simple, disciplined way to approach it. Step 1, spot the doji inside a clear trend. Step 2, check the volume. Was this just a quiet disagreement or a loud argument? And step 3, and this is so crucial, wait for the next candle. Its close is your confirmation. It tells you who actually won that tug of war. What's really interesting here is how volume adds this whole other layer of meaning. A doji on low volume, that's like a quiet little disagreement. But a doji on high volume, maybe twice the average? Whoa, that is a loud, passionate argument. It tells you the indecision is significant, and whatever happens next is probably going to be powerful. And hey, you don't have to trade in a vacuum. You can make your analysis so much stronger by combining the doji with other tools. Does it show up at a key's support or resistance level? One of those price floors or ceilings where the market has reversed before? Is another indicator, like the RSI, also flashing a warning? These extra layers of evidence can turn a good guess into a much higher probability trade. All right, let's get a little more nuanced because, you know what? Not all dojis are the same. We're about to meet the doji family, and each member has its own unique personality and tells a slightly different story. This chart breaks down the main types just perfectly. A dragonfly doji, it's got that long lower shadow, which shows buyers rejected the lower prices and swooped in to save the day, a pretty bullish sign. The gravestone is its bearish twin, where the sellers fiercely defended the higher prices. And the long-legged doji, well, that's the market in a state of high drama, just screaming volatility and extreme indecision. And here's a rare one for you, the four-price doji. This happens when the open, high, low, and close are all the exact same price. It is the ultimate sign of a quiet, coiled market, often right before a massive breakout. Pretty cool, huh? Okay, let's put this all together into a practical checklist. Think of this as your go-to framework for analyzing a doji whenever you see one pop up in the wild. You can think of this as your cheat sheet. Number 1, always wait for confirmation. Number 2, use high volume to validate the signal. 3, understand the context of the trend. And above all, manage your risk. I mean, the high or the low of a doji can be a really logical place to set a stop loss. We are dealing with probabilities here, not prophecies. So, what's the ultimate takeaway here? The doji is a really powerful signal. It shines a big spotlight on a moment of indecision, but the pattern itself isn't some magic bullet. The real secret to using it effectively is having the discipline and, yes, the patience to wait for the market to deliver its verdict.